Good evening, everyone, once again, and you're welcome to another edition of our lecture on strategic financial management. In today's class, we shall look at one of the Ican past question, which is question 5. All right, question 5 is adopted from Ican Pathfinder. Right, so let's quickly, please can someone read the requirements? Quickly, so that we can start, please.
Okay, can I read?
Please go ahead.
Okay, you are required to compute the appropriate cost of capital that AK PLC should use to appraise the project using the asset beta of the identified listed company. Sorry, I'm using my phone. As the existing weighted average cost of capital. We must go to now.
No.
Your final cost of capital should be correct whole number. Take any assumption made.
Okay. Now, the first one is compute the appropriate cost of capital that AKPLC should use to appraise the project using the assets beta of the identified listed company rather than the existing, right? Rather than the existing. So we need to use the appropriate beta identified listed company rather than the existing weighted. This is 12 marks. So the next question is now your final cost of capital should be rounded up to the nearest whole number. State any assumptions. If at all there is any assumption, then compute the net present value and the modified internal rate of return. State whether the project should be accepted or not, right? So the first question here says that compute the appropriate cost of capital. You can see that this question is the combination of the appropriate cost of capital, the MPV, and the modified internal rate of return, right? Compute the appropriate cost of capital that AK. Now, when you just see appropriate cost of capital, meaning that there will be a diversification here. So the appropriate cost of capital we are calculating should include risk, right? The appropriate cost of capital that we want to calculate should include risk. So okay, please you can read the question now. Madam Victoria, are you with us?
Yes. Okay. AKPLC is a company listed on the Nigeria Stock Exchange. It is involved in the property development and sales. The company currently imports more than 60% of its cement requirements. At a recent meeting of the board of directors, a decision was taken to establish a division for the production of cement in Ore, Ondo State. If the division is set up and the cement production goes ahead, profit from the division will be taxed at AKPLC and the standard tax assessment practice for planning purpose. It was decided that the financial viability of the project over the next 5 years should be determined.
Hold on. Sorry. No, just hold on. Thank you, ma'am. Now, if the division is set up, right? If the division is set up and the cement goes ahead, right? They are planning to establish a division for the production of cement in Ore, right? In Ore. That is where what they are planning to do, right? Now, profit from the division will be taxed, right? They are planning to establish a division, right, for cement. Okay, please go ahead.
The sum of 2 billion will be required. The sum of 500 million will be spent to acquire an existing factory considered suitable for the project. Can I go?
Yes, please.
Okay. The balance of 1.5 billion will be applied for the procurement and installation of the essential plants and equipment.
Thank you. Now, the sum of 2 billion will be required, meaning that if they want to go on this project, it will require them to have like 2 billion. Now, what is the appropriation? The sum of 500 million will be spent to acquire existing, meaning that they have to acquire a factory for the what? For the production of cement, which is relevant, and the balance of 1.5 billion, which if you add the 500 million plus 1.5, you should have 2 billion, right? Will be applied for the procurement and installation of essential plant and equipment. And I don't know the reason why I just talk the money small. I call the figure, you know, when I want to call 500 million, I say 500 million. Because of the environment, made a notice. So now, okay, please go ahead. Tax allowance.
Tax allowance can be claimed on plants and equipment at a uniform amount over 5 years with new tax scrap value.
Thank you. Meaning that there will be a tax allowance. You will claim a capital allowance on the plant and equipment only. And the scrap value at the end of the 5 years will be what? New. Meaning that at the end of the 5th year of the project, the scrap value will be 0. Okay. Now, please go ahead.
A total of 20 million has been spent on various surveys, market, technical, various surveys, market, technical, financial, etc. So, of which 10 million has been paid. The balance of 10 million is due for payment at the end of year 1.
Now, all these 2 so now, are we going to recognize it?
Irrelevant, some cost.
Is it some cost?
Some cost has been spent.
Yeah.
Has been spent, right? Okay, we move. Now, we have the production of cement for the next 5 years. It's projected as follows. Don't forget that as a project finance officer, it is not that the project has been done. You are projecting of what will happen in the future. And when you are projecting on this project, you should consider inflation that, some will say, inflation rates may be 19% at the end of December, meaning that when they want to carry out a project, they have to apply an inflation rate of 19% according to their analysis. Maybe based on the based on the reforms, probably they've seen the effects in the world, in the economy. So by then they can now project that, okay, the inflation rate could or may reduce to 19% at the end of the what? At the end of December, based on some microeconomic analysis, based on some analysis, right? Now, this is the projected that they may have at the end of from year 1 to what? From year 1 to year 5. Now, a bag of cement sells currently for 2,000 naira in the open market, meaning that one cement is what? 2,000 naira. One cement is 2,000 because they say a bag, one cement, that is the selling price per one. Now, this price is expected to increase at the rate of what? At the rate of 5% per annum, meaning that on year basis, you have to inflate the what? The selling price by what? By 5%. This year 1 raised to power 1, raised to power 2, raised to power 3, raised to till 5 years, because it is per annum. Now, the variable cost is now 800 naira per bag, meaning that one bag will cost 800 naira per bag. Now, this will increase at the rate of 4% per annum, meaning that the variable cost will increase per annum by 4%. Now, the fixed cost will be 50 million at the current price. Now, this is the 50 million. This 50 million is at the current price. Now, when they say something is at the current price, it has what? Class, at the current price is at what, class?
It's not yet inflated.
But at year 0, right?
Yes,
At
yes.
zero, we raise by 5% per annum. So from there, you now raise it to power of, you raise it per annum, right? By 5%. Now, approved cost allocation at current prices will be 10% per annum. Approved cost allocation. Please, class, is this a relevant cost?
No.
Approved cost allocation. So anything that has to do with apportionment or cost allocation is not a relevant cost. Now, project costs. Project plan costs 15%. Project plan cost 15% of the financial outlay of 2 billion is to be funded with a loan from federal government, meaning that 15% of the cost of the plant of 2 billion will be funded by federal government. We don't need this, right? That will be loan. We don't need it here. When we get to adjusted present value, when we will consider all sources of finance, we can bring in all those things, subsidized loan and all those things, right? So it is not relevant to us. Now, development bank at concessionary fixed interest rates. We have development bank at the concessionary fixed interest rate of 8%, payable at the end of each year, right? They have a cost of borrowing, right, to be 8%. That is the cost of borrowing, the cost of debt at the end of each year. We don't need it here unless when we want to determine in the MPV, we don't need it unless when we want to determine weighted average cost of capital, we ask, what is the cost of debt? Now, half of the loan will be repaid at the end of year 3, while the balance will be paid at the end of year 5. This is another information that we don't need when we want to compute our NPV. But under the theory, under the concept or adjusted present value, that is another topic, right? We may need all these sources of finance, but here under the NPV, we don't need it, right? Now, the project will require a working capital of 10% of 10% of annual revenue, which will be disallowed at the beginning of the year, meaning that if they say something is disallowed, meaning that at year 0, it is what you will use to run the project, and it will be 10% of the what? Of the annual revenue, right? Of the what? 10% of the annual revenue will be this. 10% of the what? Of the annual revenue will be your working capital. You know the way we normally do the working capital at year 0, then at the end of the year, you have to do what? You have to recoup back your what? Your investment. Now, The company uses a current weighted average cost of capital of 11% to appraise capital project. Don't forget, the question says determine the appropriate cost of capital rather than the calculated weighted average cost of capital. Now, what the company uses is 11% to appraise project, to appraise a capital project. 11%, right? To appraise what? A capital project. Now, the asset beta of the company is 1.2. This is the asset beta of the main company to be 1.2. Now, the equity beta is 1.6. Now, the risk-free is 12%, and the market return is 17% for the main company. Now, the finance director is of the view that it is not appropriate to use the existing weighted average cost of capital to appraise the new project. Of course, when you want to embark on a new project, you cannot use the existing weighted average cost of capital to do what? To discount the new one, because they have different risks. Meaning that when you use 11% to discount a new project, you may overvalue or undervalue the investment. A practical illustration, meaning that a project that's supposed to be positive NPV, or the project that's supposed to be negative NPV, now you will now use 11% to discount, it will become a positive NPV. So with that, it does not show the true appraiser of the what? Of the project, right? Because it does not consider the systematic risk, right? The systematic risk or the business risk of the new projects. Now, he has identified a listed company which currently produces cement and packaged food. Plus, what we need here is they want to go into the production of cement in another project, and they have identified a similar company, a listed company that produces cement and packaged what? And packaged fruits, drink, combination of the two, right? Now, the company has the following financial statistics, which is the Proxy company, equity beta to be 1.2, debt beta debt to be 0.4, debt to equity ratio, right? The debt to equity ratio is equals to 40%, meaning that debt will be 40, equity will be 100 as usual. Now, 60% of the market value of the company is attributable to cement. Now, class, this equity beta given to you here is the combination of both cement and packaged fruits, class, because they have identified, he has identified which currently produces cement and packaged fruit drinks. Now, the equity beta here is inclusive of both cement and packaged fruit drinks. What we need, the equity beta that we will need of the Proxy company is just for the cement, not for both cement and packaged fruits. That is the reason why you are given here that 60% of the market value of the company is attributable to cement production. Cement production, right? Why 40% of the value is attributable to the food drink division. Can you see? It's attributable to what? The food drink what? Division. Now, the food drink division has a higher equity beta of 1.8. The food drink. Now, can you see where they apportion it? They said, oh, if that would be the case, 60% class, 60% will be for what is it called? 60% will be for cement. Why 40% will be attributable to food drinks? Now, the food drink now has a higher equity beta of what? 1.8, right? That will be the equity beta, but they said it is just 40% of it that is needed for the what? For the drinks. So now we need to make S the subject of the formula there for us to get the one for our cement, right? We'll get there. Now, the new project is expected to move AKPLC to the target debt to equity ratio of 30%, meaning that their debt to equity ratio will reduce. Of AK for the main company. Will be 30%, meaning that market value of debt will be 30 and the market value of equity will be what? Will be 40. Right? Tax rate is 25% to be recovered as credit and is being paid in the year profit is being made. Meaning that the tax is not being paid in what? Is not being paid in arrears. Class. Meaning that the tax is not what? Is not being paid in arrears. Now, we want to determine the appropriate cost of capital to be used, right? Using the asset beta of the identified listed company rather than the existing weighted average cost of capital. Class, are we still together?
Yes, sir.
Yes, sir.
Okay. Okay. Now, suggested solution. Suggested solution. Our first step, based on our identification, is to what is the proxy company? Step one. Step one, it wasn't stated. We're only told that they have identified a listed company and he has identified a listed company which currently produces cement and packaged foods that have this following information, right? So we can quickly go back to suggested solution. Okay. We don't know the proxy company. We can say proxy company. Step two. Now, step two, we need to determine what? What is our step two? What is our step two, class?
Ungel the equity beta of the proxy company.
To remove the financial risk of the proxy company.
Thank you. On by removing the financial risks of the what? Of the proxy company. Proxy company, you are left with asset beta. That is calculate asset beta. What is that? That's our long formula for calculating asset beta. It will beg. Let me quickly check for risk adjusted. Please, what is the formula, sir? What is the formula? What is the formula?
Beta of equity multiplied by value of equity.
Okay.
BE times VE
Times
all over
VE.
VE all over VE plus VD into brackets 1 minus T plus BD.
Okay. Oh,
plus
Times
VD times VD into brackets 1 minus T all over VE plus
Right,
VD into 1 minus
you
T.
read that from your notes.
No, from notes.
Me, I'm
Don't
reading
mind
it from my note too.
Don't mind me. Oh. You are reading it from your notes. Who are you? You're on your own. Oh. Hey, who are you? So now, because this is Ican or not ACCA. In ACCA, they will give you all this formula. If you check ACCA, you see it there. You just give all this formula here. So this is Ican. You need to. But I think Ican too will give you, but maybe you will even understand that formula there. But that's fine. So now, what do we want to do? We need to determine the asset beta of the what of the proxy company. Can someone help me to respond to this chat on the group? Your screen is not cleared on YouTube. Okay, increase your quality now. So if you want to determine the asset beta, right? The asset beta, right? Now, how do we determine the assets? Is it asset beta or equity beta? Sorry, Simeo. Now we want to look at it. Ideally, we're supposed to bring this equity beta and say, oh, equity beta, beta debt, blah blah blah. We move on. Sharp. Is that not so? But because the equity beta given to us is the combination of the production of cement and packaged food. It has identified a listed company which currently produces cement and packaged food, meaning that the equity beta given to us, that is the reason why they said in the after the paragraph, 60% of the market value of the company is attributable to cement production. Is attributable to cement production. Is attributable to cement production. 60%. Why 40% of the value is attributable to the food drink division? Class, the food drink division has a higher equity beta of what? Of 1.8. Now, this equity beta here is the combination of both cement and packaged food, meaning that cement plus packaged food is equals to 1.2. Now, can we do something? Now, so determination of equity beta for cement production. Class. So equity beta equals to cement plus package foods. Class. Are we still together? Are we still together, please?
Yes,
sir.
it is fruit drink, not packaged fruit.
Thank you. Foods, drinks. Thank you. Now, the equity beta class, we're supposed to like in normal, like this is the listed company now. That is the proxy company. We can just pick equity beta sharp. We don't like before we know we are done with the calculation, but because this equity beta is the combination, please, you need to pay attention to every question, most especially like these questions like this, right? You have to read it and understand that, okay, it has identified a listed company which they have equity beta of 1.2. for both cement and packaged food. So we can say, since okay, equity beta is 1.2 equals to, right? 60% will be for what? 60% will be for the what? Cement production, right? 60%. Don't forget that what we are looking for is cement. Is that not so? So I can come here and say, let's S represent cement production, right? Now, 60%. 60% of what? 60% of X times X plus, how many percent is for food drinks? 40%, right?
40%.
40%. 40% of, they've given us the food drink, what is it called? Equity beta there.
1.8.
1.8. The food drink division has a higher equity beta of 1.8. Now, this 1.8,
Is it
it is
1.8
not,
or 0.8?
I don't know.
It's 0.8 I'm seeing here. Oh.
In my, yeah, I'm seeing 1.8 here.
The 1.8 is for the full company, the total company.
Is a reading from the past question.
Yeah, reading from the past question. Away.
Okay. Sorry, I was using past question.
Okay. Okay. Oh. Yeah, I don't change them now. Okay. Oh. Now, so I've changed it. So here you have 1.8. So we can have 1.2 equals to 0.6x plus 0.4. 0.4 times
0.7.
what do we have?
0.72.
0.6x plus 0.72. Okay. A minute, please. I'm coming. This on the page. I'm coming. Okay. So we can have 1.2 minus 0.72 equals to 0.6x. So what do we have here? 1.2 minus 0.72.
0.48.
0.48 is equals to 0.6x. So therefore, x, which is the equity beta for the cement, is equals to what?
0.8.
0.8. 0.8. If you check the past question, they gave you the one you checked, the one you are looking at is yes, I remember Vicotoni that has free cash flow, right? Something like this. You can also see that when you have development division and computer hardware thereabout, right? So I think that is the one that has 0.8, right? So now x is equals to what, class?
0.8.
0.8.
0.8. So this is 0.8 will be for cement equity beta for cement production. So we can now insert it in our formula. Fumi, are you still with us or against us? Fumi. Okay. So the equity beta for cement production is what? 0. What? Excuse me. 0.8. Right? And that is what they want us to unlock in this particular question. It's just this part. That is why it is 15 marks. I think 15 marks to 12 marks thereabouts because of this 20 year, because of this English. Right? Please, do we have anyone that is confused? Are we good?
Sir, please, I will appreciate if you can run us through it again, please.
You say?
I will appreciate if you can run us through this.
Oh no. Are you just did you just join the class?
No.
Uh-huh.
I'm looking at it, but it's still doing my head somehow.
Okay. Oh. Okay. Oh. Now, if you look at this part, you see that you have cement and packaged food. That is the reason why I always believe in you understanding of question. Once you understand question, you can solve it, right? Now, once you pay attention to this part, that they have cement and packaged food, and they give you the financial statistics. Now, from all this information, they did not tell you that better depth of cement is this. The one of package is this. We'll assume to be for the cement. Now, they now give you additional information on the equity beta. That's CEO, the equity beta that will be attributable to cement, or it wasn't mentioned that equity beta, it's a market value that will be attributable to cement is just 60%. To now, why the one for drinks will be 40%, and the fruit equity, the fruit drink division has a higher equity beta of 1.8, meaning that we cannot have two unknown. You cannot assume that don't forget the equation that equity beta is equals to cement plus fruit. Now, the fruit higher of 1.8, right? Higher of what? 1.8, meaning that this 1.8 self, you cannot say 1.2 equals to 60% of X, which you are looking for, plus 40 of plus 1.8, because they give you 1.8, just use it. No, now 1.8 is already greater than 1.2. They tell you that they've given you the equity beta to be 1.2 of the two company class, of the two production to be 1.2. So you cannot use only 1.8. Yeah, because the 1.8 here is already greater than the 1.2 that is equals to. So that's the reason why they say, oh, they not give you 40% of it will be for the fruit, because you cannot have two unknown. Right? You cannot have two unknown. So that is why it's okay. Let S represent the production, the cement. Right? We can have two unknown. You can see that in the last part, they didn't tell you that 1.8 or 1 point something is for cement. No, because they want you to calculate the equity beta for cement. Esther.
And with you, sir.
Kajiko, Akwe Hausa?
Yes.
Okay. Oh. Now, we move, right? So we can move on, right? So now, let's quickly go back to the question, right? And don't forget that The better debt is given to be 0.4. The debt to equity is given to be 40%, right? So better debt is given to us in this question. So definitely we have to continue. So better debt is given to be 0. What class? 0. What class? Better debt is what? Away.
0.4.
0.4. Right? Better debt is 0.4. The level of gearing given to us in the question. Still no. Okay, that's fine. Debt to equity, don't forget, is equals to debt to equity is equals to how many percent? How many percent? I need to check. Debt to equity is
40 over 100%.
40%. They give us 40%, right? 40%. So meaning that, please mute your mic, meaning that debt will be 40, then equity will be 100. You can see that this is given in a percentage. Don't forget that they may give you something to calculate the market value of equity and the market value of debt. Don't forget the usual way of determination, how we determine the market value of debt and the market value of equity under the cost of capital, right? Now, meaning that the market value of debt will be 40, then the market value of equity will be what? 100, right? So if you have this, what is the tax rate for the POSI company? The tax rates for the POSI company, what is the tax rate, class? Given to us in this question? 25%. Okay. So the tax rate is 25%. That is 0.25. Let me check the tax rate of that 25%. Where is the tax rate of the POSI company? Okay, let me scroll down. Okay. The tax rate is 25% to be recovered as credit, and it is being paid in a yearly profit. You can see that it doesn't mention that this particular tax is for the POSI company or for the main company. So part of our assumption that we will state is that the tax rate of 25%, it is assumed that the tax rate is for both the main company as well as the POSI company, because assumption is allowed. In fact, it is even 3 marks. It is allowed. Now, having all our variables, right? We are done with all these variables. So I can come here and insert the formula, right? So equity beta, what is the equity beta? Calculated, what is the equity beta? 0.8, right?
Yes.
0.8. The value of equity?
100.
100. The value of debt is 40. This is 0.25. Our value of equity is 100. What is the better debt? What is the better debt? 0.4. You can see that in this question, the better debt is given 0.4. The value of debt is 40. This will be 40. 0.25. 0.25. So what is the asset beta? Class, what is the asset beta?
0.7. 0.7.
0.7 is the asset beta. Step 3, we have to regear by, we have to regear, right? I'll just write it this way. Regear. So what is the formula? If you want to regear, I don't have that time. Let me just copy this. BE equals to assets beta, right? PE. So the assets beta, okay, let's say we have BA should be 0.7. Class, don't forget that this beta debt from this part here, class, from this part is for the main company. For this part here is for the main company. Beta debt, right? So you can have BD, then the level of gearing for the main company. So, and the tax will remain the same, 0.25. So what is the level of gearing? Now let's quickly go back and check for the main company. You can see that in this part of the question, it was stated that they have this, they have the equity beta to be this, they have the asset beta to be this, risk-free, and the market return. And now, what is the level of gearing of the main company? Where is it to? Where is it to?
30%.
How many percent?
30%.
How many percent? 30%. Thank you. Thank you. The new project is expected to move KPLC to the target debt to equity ratio of 30%. Now, ideally, I can see this particular paragraph is supposed to be here. It's supposed to be maybe somewhere here, right? They're supposed to state it before the deposit company, but they just like you now start looking for where is the level of gearing now? Where is the 30%, 30%, 30%? But when you check, right? When you check this part of the question, when you have the new, when you have the new project is expected to move AKPLC to be this, right? So you can now see that you have your level of gearing to be debt to equity of 30%. Right, so debt to equity to be 30%. So meaning that market value of debt will be 30, then equity will be equals to 100. Right, will be equals to what? 100. So where is our formula? So we can come here. So do we have anything that has to do with better debt of the main company? Do we have?
Yes. Yes.
Where is it?
No.
Better debt. Where did they mention better debt to? You say there is now.
We are given equity and assets, and equity and assets, there is difference between both of them. So I think that will make up the debt.
I don't understand. Where is the equity and assets?
Asset beta was given as 1.2, equity 1.6.
Okay.
So in between, there's 0.4.
So you will now say asset beta, equity beta 1.6 minus asset beta 1.2. We give what? Better debt away.
No.
Yeah.
That is your assumption, though. If you feel
That's assumption, but I've thought similar thing in the past. That's why I picked that.
Okay. That's fine. That is assumption now. That is why I said that is your assumption. Is that not so? That is why I said that is what? That is your assumption. right? The better debt is not given to us in this question. So therefore, the better debt.
Yes, assumption, yes.
Yes, thank you. So the better debt we assume to be 0 because it is not given to us in the question. Me, I will now say, if I want to state my assumption, I will now state it that better debt of the main company is assumed to be 0. Is that not so? Right? We are good. Now, since the better debt is not given, right? So we can have the better debt to be 0. To be 0, right? So therefore, equity beta what is our asset beta is what self 0. What
7.
7.
0.7 0.7 0.7. So this will be 0.7 while we have 0. So value of debts is 30. Then tax is 0.25. Then equity beta, value of equity, you have 100. Sorry, not equity beta. Okay. Value of equity. So what is our asset beta here, class? What is the asset equity beta? Sorry. What is the equity beta?
0.85.
0.85.
0.9. Yes, okay.
0.85 is our equity beta. So what is the next step? We calculate the CAPM by including the risk-free plus equity beta, market return minus risk-free. So what is our risk-free given to us in this question?
12%.
What is the risk-free? We have 12%. The risk-free to be 12%. Class, when you are if you want to do something like this, right? This part of when you have all this information, you can extract it out. Equity beta, where you have the risk-free. Where is the risk-free? The risk-free to be 12%, and the market return to be what? The market return to be 17 cents, right? Please don't use this. So don't use the equity beta given to you in the question. This equity beta does not include any risk, right? It only includes the financial risk of the main company, right? So where are we? So here it is. Okay. So cost of equity equals to what is the risk-free is 12%. Equity beta, this equity beta here.
0.85.
0.85. The market return, what is the market return?
17.
17 minus 12. What is the cost of equity?
16.25.
16.25. 16.25% or 16%. So the last step, step 5, is to determine the weighted average cost of capital. Class, what is the formula for calculating weighted average cost of capital? No, don't say it. I need to call. Coming. Mary, are you still with us or against us?
Yes, sir.
Okay, please, what is the formula for calculating the weighted average cost of capital?
Cost of equity times open brackets value of equity divided by value of equity plus value of debt plus value of preference shares close brackets, plus cost of debt, 1 minus tax rate, then open brackets, value of debt divided by value of equity plus value of debt plus value of preference shares if there is. Close your brackets. Then do for preference shares too,
Okay.
if there is.
Okay. Yeah, I don't know where we see preference shares, but all still join. It's still part of.
On
It's
just
still part
page
of.
with their read.
Yes, 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 yes. I understand. I understand you. So it's still part of market value of debt. If you remember, that we did something like this when we have bank loan, when we want to determine the market value of debt, when we have to add both the one of irredeemable market value of debt and the one of loan. That is, we had them together. It gave us the market value of debt that we use to determine the weighted average cost of capital, right? Remember that we did something like that, right? That makes sense, makes sense. So now what we have here is the weighted average cost of capital, right? Then let me bring it out one after the, okay, value of equity of the main company. We've done that already, right? The value of equity, see, just come to this step. This is your step here. This step 3. You've done the value of equity and value of debt. You can see, just pick all the information about the value of debt and the value of equity of the main company. Just pick it from here. And the tax, right? So we already have the value of equity to be 100. Then the value of debt is equals to 30, right? Then, or let's start from, okay, then cost of equity. What is the cost of equity? We have 16%. Excuse me. Is that not so? That would be your cost of equity. Class, are we still together, please?
Yes,
Since I'm
sir.
the only one in this class.
Yes, sir.
Okay. So that would be the value of cost of equity. Now the cost of debt. What would be the cost of debt? So let's quickly go back and check the cost of debt of the main company. So how do we determine the cost of, so from this question now, where is our cost of debt? From this, all this information for the main company, where is our cost of debt?
8%.
8%. Are you sure it's 8%? No, I'm not sure.
Yes.
I'm not sure it's 8%.
Fixed interest rate.
Pere.
8%.
Okay, 6%. For me, is it 8%?
I'm trying to remember. I'm just here.
We check now. Is it 8% cost of debt? Yes, it is 8%. Don't forget that we usually have bank loan. Right? We usually have convertible debt that you will have interest rates beside the convertible debt in the financial statement. That interest attached to it, it is the debt, the cost. Now, we're not given the financial statement, but it was stated that the development bank at a concessionary fixed interest rate, meaning that they borrow money from development bank and they have to pay back, and which is fixed interest of 8%. So this is the 8%. This is what? The 8%. So is this 8%? Is it post-tax or pre-tax?
Pre-tax.
Pre-tax. So it is assumed to be pre-tax because it wasn't stated that it is after tax. So we have to do a tax relief. We should not forget that this is our formula for doing that, right? 1 minus tax rate. Is that not so? So equals to interest is 8%. Interest is 8%. 1 minus tax rate. What is tax rate? 0.25. What do we have, class? What do we have?
0.6%. 6%.
0.6.
06.
06. Okay, that's fine. So after this, we have the tax rates. Okay, we have the tax rate to be 0.25. So we can now come and pick our formula here. So value of equity to be 100. Cost of equity, please mute your mic, to be 0.17. Value of equity to be 100. Value of debt to be 30. Here we have value of debt to be 30. Cost of debt, we've done that, 1 minus tax rates, to be 0.06. Value of debt 30. Then value of equity to be this. So what is the weighted average cost of capital? The appropriate weighted average cost of capital, class. What is the appropriate weighted? What do we have?
0.14. 0.14.
0.14. That is 14%. That would be the appropriate cost of capital to be used to discount the project, because it will include both the business risk, right, of the new project and the financial risk of the what, of the main company. So if you have questions, quickly unmute your mic quickly so that we can move ahead, please.
Hello, sir.
Yes,
Good evening.
Good evening.
Now, my question is under that work. We have a pre-tax of 0.6%.
Pre-tax, it is not pre-tax, it is post-tax of 0.06. 0.06.
So are we not having double taxation here?
How?
That's what I'm looking at.
How? What is your argument on double taxation?
My argument is that under the work, we have tax rate of 0.6. We also have another tax rate of 0.25.
Is that, where did you see 0.25?
Cost of debt.
So if, wait, okay, let's go back to cost of capital. If you want to determine the cost of debenture, what is the formula for calculating the cost of debenture?
I can't remember, sir. I cannot remember. I don't remember.
Okay, it is not double taxation. Thank you.
Okay.
Kende.
Excuse me, sir. That was actually, I wanted to,
okay,
during the is it that bank loan? That's why. So thank you, sir.
Okay. That's fine. So you can also use ash total. You can use ash total, right? For this, you can use ash total. Don't forget that. What is the formula of our ash total? Items market value. Total market value. Is that not so? Total market value is both your equity and debt. Is that not so? This is it. You are dividing it. Is that not so? Now, after that, you have cost of capital. Is that not so? Yes, cost of capital can be equity or debt. You will use equity to multiply cost of equity. You will use debt to multiply cost of debt, class. Then when you want to determine your ash total, what will you use, class? You will use your ash total. What you use here, is that also this one? Or this one, the one of value of equity plus the one of value of debt times cost of debt. Is that also everything together? That will be your ash total. Everything like this here is your ash total. Then you divide it by the total market value of this. It's still the same thing, right? So we move. Any other question? So we are good to go. So this is okay, 12 marks. That's fine. So you state your assumption, right? What are the assumptions? What are the assumptions? We assume that they have the same tax rate. Is that not so? 1. We assume that the better debt of the main company is equal to 0. Just state it like that and you move on. 3 marks. Lastly, compute the net present value and the modified internal rate of return. So this is net present value. Net present value, whether the project is acceptable or
Yes, sir.
or not.
Hello, sir. That's work. Okay, it's divided by 130. All right, thank you.
Divided by 200. So, don't mind me. So we have what is the next question, self? I think it's on net present value, right? Net present value. Okay, net present value. Okay. So we have to do some adjustments quickly. Okay. Okay. Now let's start our adjustment from the selling price. We're told that the selling price will have this, right? A bag of cement sales currently for 2,000 in the open market. This price is expected to increase at the rate of 5% per 5% per annum. Is that not so? So
Yes,
5% per excuse me, 5% per annum on. Okay, just let me copy this. Selling price is what? 2,000, right? 2,000 naira, and it will increase by 5%. Okay, by 5%. This is so much. This is A, B, C, right? Okay. So selling price. Let's do the selling price adjustment. So selling price. We have 2,000. No, wait. What is the year 1? Okay. Okay, let's have it like this. Year 1. Okay, so the first year we have the 500,000 units times the selling price is 2,000 naira, and it's going to increase by, you increase by what? By how many percent?
5%.
That is 1.05, right?
Yeah.
X to the power 1. So you have 1. So what do you have here?
2-1.
Okay. Let's have something like this.
Is it the total revenue for that year?
Yes.
Total revenue is in millions. 1050.
18.
No, 1050 in millions.
1050.
1050. Okay.
Yeah.
1050, right?
Yes.
Yeah.
Yes. No.
Okay. So
What
the
I mean
second
is
year,
that, hello, sir. What I mean is that you write 1050 and 60 before it, after it is in millions. That's what I mean.
okay, that's fine. You have
Yes,
you have 3
just write
zeros.
what
You have
you have
3 zeros.
6.
I'm confused. Okay, let's have
0 after 1050.
Yeah, you have 6 zeros.
okay, even after the 00, yeah, you still have another 0,
3.
yeah.
Yeah, yes.
Like it? Okay.
It's not
Let me
like
just
that.
Away. Okay, it's like how? Well, now, quickly, please. Quickly. Is it like this? Is it millions now?
1,050,000. That is 1050.
Okay, 10. Okay.
1,000,000.
please check the chat box. I wrote it, the value there.
Okay, 1,050,000. Like this, Abby. Okay, let's see.
Exactly. Yeah.
Okay, that's fine. That's fine. Thank you.
6,000. Sorry.
You said what?
Still
The
put
zero
the
is
three
not
zero.
complete. It still has 30.
Apart from the one that is up, it still has 30. Yeah.
It's a
I
million.
think it's okay like that. It's okay like that. You can leave it like that. It's
Okay.
okay. Yeah.
Okay. Now, what is the next one? We have year 2, right? 600. 600,000 times 2,000 times 1.05. 1.05. Are we going to raise to power 2
Yeah, raised to power
for the
2.
second year? For the second year. Class, are we going to say raise to power 2?
Yes, sir.
Yes, sir.
Yeah.
Okay. Thank you. So, what do we have here? Figure,
One
please. Figure.
three two
1
one three
million
323.
3,000.
One what?
1323.
1,323.
1,323,000.
Yes, thousand.
Okay, that's fine. So, next, we have 650, right? 650,000, 650,000, 650,000 units. 650,000 units times 2 times 1.05 raised to power 3. So what do we have, please? Quick one. What do we have?
1,505,000.
1,505,000. Next, what is the next one? Year 3, year 4. 800,000, right? 800,000 units times times 2,000 times 1.05 raised to power 4. Next, what do we have? Next, what do we have? Figure.
1,945,000.
1,945,000.
1,945,000. The last one is 700. I guess it's 700. Is it 700? Okay, 700 units, right? 700 units. 700 units. It's 700. Okay, 700 units times 2,000 times 1.05 raised to power 5. What do we have?
1,787,000.
1,787,000.
7.
Okay. So we are done with the what? The part of sales, right? Which is the revenue. So a minute. So So, where are we? 17178. So, where are we? Okay, sales, right? So next, what next? What next? What next? Quickly. We don't have time.
Variable cost.
Okay, thank you. Variable cost is what? Variable cost is now 800 naira per bag, right? Variable costs to be 800 naira per bag. Oof. So variable cost to be 800 naira per bag. We may not finish this MPV, so you can complete it. Okay. Okay. So the variable cost. So increase by how many percent? Sorry. Variable cost will increase by how many percent?
By 4%.
Okay, 4%. Yeah, 4%. Thank you. The variable costs will increase by 4%. So we have 800. So 0.4. Please figure.
6 million.
I'm coming. Sorry. So increase by 4%. So this will be 4. Then we have okay. So the first one is what? What do we have? Hello.
We have 416000.
416.
416 000.
Like this, Abi? Is this correct?
No, it's not correct. Remove 10.
Okay.
519.
Coming 41600. Like this?
Yeah, that's correct.
Okay. So what do we have here?
$519,000.
519,000. What do we have here?
585,000.
Okay. 585,000. What do we have here?
749,000.
749,000. Okay. So after variable costs, we have incremental.
Yeah, 5. What are the
Is it not up to
700.
Even this one too is not up to 5. Oh. The sales, is it up to 5? Oh, it's up to 5.
5.
Okay. Okay. Sorry. Units times 800 times 1.05 raised to power 5. So what do we have?
681.
Okay, 681. That makes sense. 681. So incremental fixed cost, right? Excuse me. So we're told that. What do we have in the incremental fixed cost? Quickly. Incremental fixed cost. Can you see it? Where is incremental? Now, fixed cost will be 50 million at the current price. Excuse me. Which means at year 0. Then, after that, but we rise by 5% per annum. Year 1, you increase it. Year 2, year 3, year 4. Is that not so, class?
Yeah.
Okay, 50 million. How many percent per annum? 5% per annum. 5% per annum, 5% per annum, right? 5% per annum. Fees cost, okay, 50 million, right? Okay, let's say 50 times, it will increase by 5% per annum, 0.5, right?
Yeah.
There are two methods, since you have the same thing, right? There are two methods you can use to calculate this, but that's fine. But let's quickly move. What do we have here? If you multiply it, what do you have?
52,500,000.
55.
Is it 53 or 54 or 50?
52,500.
53.
Okay, 53. 53, 500.
It's 52,500. But since we are running to 100,
500. But approximation makes it 53,000.
Is it 53 or 52?
52,500.
500. Approximation 53.
52,500. So you can decide that you can decide to do it this way and bring in the same figure times this raised to power of 2. You can raise it to power of 2, or alternatively, if you don't want to raise it to power of 2, alternatively you can bring the same figure here. Okay, if you raise it to power of 2, what do you have? What do you have here? Class now.
55, 125.
55, 55, 125,000. Is it million?
Yeah.
Okay. 55, 125. Is that not so? Now, if you don't want to do it like this, I can decide that, oh, if I don't want to do it, if I don't want to raise it to power of 2, since it is the same variable, now I can bring in the 52,500 here and just multiply by 1.05. What do we have? We have the same thing. Is that not so?
Yes, sir.
Yeah.
You have the same thing. So you have two methods. Since the figure is the same, all true, you have 50 million, the same. So another person can decide that, okay, since you have this thing here, I can bring in the figure here, multiply it. So when you don't raise it to power of 2, because if you raise it to power of 2, it means that you are doubling it, like you are, like it is double, just like the ones someone just mentioned, double taxation, right? Because this is already in year 1. If you multiply this by this, it will give you year 2, right? It will give you what? Year 2, whichever method we want to use. So which one should we adopt? Is it raised to power of 2, or we pick it from the next one?
Let's use the one we have been using before, sir.
Okay, consistency, right? Thank you. So here is raised to power of 3. Raised to power of 3. So what do we have?
57881.
57881. 881.
Yes.
So what do we have here?
60775.
Raised to power of 4. 6 what?
0775.
60775. So what do we have? Raised to power of 5.
63814.
63814. Okay, 814. What else? Okay. After the incremental fees costs, we have the working capital, right? Now, don't forget, what did they say we should discount? Okay, compute the MPV and the modified internal rate of return. State whether the project should be accepted or not, right? So what are you going to use to discount the project? What are we going to use to discount the project, class?
Which data
Hello?
is column?
Which one? Which one of the?
That's
The one we calculated.
40%.
Okay, thank you. Thank you.
Yes,
Thank you. Thank you. That makes sense. So let's quickly go back to the question. Let's check what is our working capital. This is not relevant, right? This is not relevant because it will be financed by government loan. It is not relevant. Where is our working capital, class? Working capital. The working capital will require the project will require a working capital of 10% of annual revenue, which will be disallowed at the beginning of the year, right? So, you know, working capital is usually what you use to run the business, right? Of course, at the beginning of the year or at the beginning of the project, you don't expect to recoup your working capital now. Is that not so? That is the reason why they say it will be disallowed at the beginning of the year. So you use working capital throughout the project period, right? Meaning that, and it will be how many percent of the, how many percent? 10% of sales. Is that not so?
Yes, sir.
Yes, 10%.
Okay. 10% of sales. Let's say we have 0. We have year 1. We have year 2, year 3, year 4. Up to year 4, right? Year 5. Year 5, right? Year 5. So we have these are just working. So once when we are done with this, others is just simple. Just pick it from here, right? So in our next class, we move to capital rationing. Yes, we are supposed to solve a question on conversion of, okay, we did one and we solved one question on conversion of money to real, so it's no problem. So what is our working capital? What is sales or the revenue for each year? Let's quickly okay, revenue for each oh, it's even up to 4. Okay, that's fine. So this is 1,050,000. 1 million. What is the next one, sir? 32. 1,505,000.
1945.
Okay, thank you. 945.
1787.
Thank you. 1787. Thank you so much. That makes sense, right? So working capital will be 10% of the sales. So what is this 10% of this class? 10% of this
105,000.
105,000. Next.
132.3.
Okay. 132,300. Next.
150,500.
150,500. Next.
194,500.
194,500. Next.
178,700.
178,700. Good. So we can now have what we call changes in working capital. Working capital, right? And don't forget, class, we are picking it from this part, right? You have your year 0, meaning that from year 0 to year 1, it has increased. What you have in year 0 is 0. Is that not so? So it has increased to 105 in year 1. So you have 1050. Now, you have 105 in year 1. Year 2, you have 132, meaning that your working capital has increased, meaning that there will be a cash outflow. Don't worry, we will get to free cash flow as well, whereby we will use these terms, right? You can see that it will reduce your cash flow. An increase in working capital will reduce your cash flow, while a decrease in working capital will increase your cash flow. Now, from 105 to 132, 300. Class, what is the increase?
27,300.
37.
27.
Okay, is the difference, so please, is the difference, right? So please, take note, is the difference, so maybe you can write it in your notes. 132,300, from 132,300, it increased to 150,500. What is the increase, class?
18,200.
18,200 is the increase in working capital from 150,500 to 194,500. What is the increase?
44,000.
44,000 is the increase, right? From 194, from 194 to 178. What happened to the working capital? It decreased, right?
Yes.
So what do we have? What is the decrease?
15,600.
15,600. It will not be in jacket, right? So 15,600. It will become an inflow, right? So next,
15,800.
800.
15,800. Now, class, look at it. At the last year, you have 178. Just say 178,700. The next one is 0, right? 178,700 minus 0, you have 178,700. Or you just assume to be your final year will be 178,700, right? It will be what? 178. Okay. 178. Okay. 178,700, meaning that you don't have any increase anymore. There's no increase. Now, this 105 that you have here, it means that that is what you use to start the project at year 0. Now, if you do 178,700 plus this, minus this, minus this, minus this, you should have 105,000. Did you have 105,000?
Yes.
Thank you. Class, are we good? Class, are we good?
Yes,
Who is
sir.
against me in this class? Who is against me? I'm very sure. Okay. That's fine. Let's move on. Right. What do we have with it? So if we have this as our working capital, So we cannot go further and say computation. What is the name of the company? AKPLC. So we have determination or computation of net present value. Right? Net present value. Okay. Tax is being paid when? Is it in arrears or in the year at which the profit is being made? If the tax is 25% to be recovered as credit and is being paid in the year profit is made, meaning that it is not in arrears. They pay the tax in that year, right? It is not paid in arrears. Class, if you have taxes being paid in arrears, you have to add year 6 because year 1 will be paid in year 2, year 2 will be paid in year 3, year 3 will be paid in year 4, year 4 will be paid in year 5, right? And year 5 will be paid in year 6 if the tax is being paid in arrears. So we can have here revenue, right? So we have revenue. Let me copy this, right? So after the revenue, we have the variable costs, right? So I can have here, let's just have less cost, right? Okay, still have less. Okay. Variable costs. We have variable costs. Where is the variable cost? Okay, these are the variable costs, right? Variable cost. Oh. Please figure variable cost. The first year we have 519,585. Next, what do we have?
The first one is 416.
416,000.
Okay, thank you. 416,000. Next, we have
519. Okay. The next is
749. 681. What do we have? We have incremental fixed costs. We have incremental fixed costs. What is the first year? Incremental fixed costs.
63,000.
Okay. I'm coming. Okay. I'm coming. Just hold on. Let me copy this so that we can just switch it on. Right. Okay. The first year, 52,500. Next, we have 54, 55, 125, 125. Please, I already have 300. So, is this correct? I already have 3 here.
No, you remove the zero. You just do 2,500.
Okay. Thank you. Like this, right?
Yes, sir.
Okay, thank you. So we have 57,881. What next do we have? What do we have in year 4?
775.
Okay, 60,775. 63,814. Thank you. What do we have again? We have to, after that, we have the working capital. So what is the cash profit? What is the cash profit? Cash profit. What is the cash profit? Class, what is the cash profit?
581,500 for year one.
581.
500.
500. What do you have here?
748,875.
748,875. What do we have here? So you can complete this, right? So let me just bring this part. Sorry, working capital. Can complete this, right? So I need to okay. The working capital we have here. This is the working capital, right? Working capital. There is no scrap value because it is new. After this, we have the investments. What are the investments? Let's quickly go back and check.
We have acquisition of factory, 500.
500. Okay, I'm coming. Okay, I'm coming. So we have factory 500. After the factory, what do we have again? We have the plants and equipment, 1.5 billion. Is that also 1.5 billion? We have 500 and 1.5. So quickly, we have factory.
Sorry, sir. We didn't have tax depreciation in the question.
So there's no, so we didn't have it now. So we move on. They didn't tell us to do capital allowance now. So we move on. Did they say we should do capital allowance? Did they mention
tax allowance can be claimed.
You said?
Tax allowance can be claimed on the plant and machine and equipment.
Is that what it was mentioned there? Was it mentioned?
Yeah.
Okay,
Yes.
okay. Thank you. Where is it? Where is it? Oh, thank you. Where is it, self? Tax and tax. Oh.
Second paragraph.
Okay, tax can be claimed. Okay. At a uniform rate over. Okay, at a uniform rate. That is straight line method. Is that not so? So we can have class. Please take note. So thank you so much. All right. So we have tax savings. We will have the computation. We have the calculation of tax savings on straight line method, right? So you can complete. Let me just calculate these parts, right? Determination of tax savings, right? Of tax savings. So what is the cost of the plants? What is the cost of
1.5 billion.
1.5? Let's say we have 1.5 This will be in million, right? Oh, already have, okay, 1.5 billion, right? So we have 0 there, right? So if you multiply by, what is the, which rate are we going to use, class?
Straight line.
We need to use straight line method, right?
Yes.
Okay. So what is the numbers of years for plants?
5 years.
Based on tax. What is the numbers of years? It's 5 years, right?
Yes.
Okay. If you divide this by 5, they said the square value is nil, right? So if you divide this by 5, what do you have?
300,000.
300,000. 300,000 times 25%. What do you have?
75,000.
Okay. So the depreciation here, the capital allowance is on straight line method. You can have, when you divide it, what do you have? Sorry.
300,000.
300,000. Right. So the tax savings will be 300,000 times the tax rate. Is that not so? The tax rate is 25%. What do we have? What do we have? 75,000. So meaning that this 75,000 will be throughout the year, from year 1 to year 4. That would be the tax savings, right? That would be the what? The tax savings from year 1 to year. So you can still have tax savings. So please complete it and calculate the modified internal rate of return, right? So because my I have, I think this is just 18%. So class, so you can have here, before this, you can have tax savings. Start savings, right? 75 tax savings, then tax savings. So before we have the factory, blah, 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 as well as you just put the 1.5 billion as the plans, as well as the acquisition of the factory, which is 500 million, right? 500 million. So class, are we good? Class, are we good?
Sorry, in that question, I think 2 billion was expensed on, I think, plants. So they were trying to split that 2 billion. I think one part is
split it. This will be plants. Put this one to be plants. Put this one to be factory.
I think one part is irrelevant, while the other part is relevant.
Why will you say the other part? Factory.
Please, can you move to the question section?
Wait, Toib, now wait. They want to go into production of cement, and you say acquisition of factory of existing factory is not relevant. I beg. Where will they use? Where do you want them to get the factory?
I'm not saying it is not relevant. I want us to look at the breakdown so we can ascertain probably there is nothing wrong. I think there is 1.5 and 5. So
Toib, 1.5 billion plus 500 million is 2.5 billion. 500 million will be acquired for the existing factory, suitable for the projects. Is that not so? There's nothing wrong.
It is clear now. All right.
Thank you.
Sorry, I wanted to ask. The part you highlighted yellow, a total of, sorry, hey, to the question.
This?
No, please go up, go up. Yeah.
All
Said
these
a total of
ones,
20 million has been spent, which we know is
they are not,
irrelevant. The
yeah, they
10
are not,
million.
no, it's
But
not
the other
relevant.
10 million that is due for payment at the end of year one.
It's not relevant. Anything that has to do with loan payment, anything that has to do with loan payment is not relevant. It is part of financing, finance costs.
Okay.
Do you get? It is part of finance costs. It is not relevant. If you check the notes, the relevant costs actually stated there that they are all financing. When we get to adjusted present value that consider all sources of finance, that is when we now input all these things of subsidized loan. What is it called? Which name did they normally call it? Cheap loan and all those things, right? We get there.
Okay. I didn't know it was a loan. Thank you.
Yeah, you're welcome. Please, any other question? So, please, what time should we fix our class on Saturday? Time. I'm thinking if we can even start early self.
The 11 is okay. Oh.
11. Please, you can ask those who were in class last diet. So sometimes we start class 8 a.m. in the morning. Okay. 11. Okay. 11. Okay, 11, right? We should maintain that 11. Okay, that's fine. 11 for now. Maybe by September, maybe we shift it to 10 to 3, 10 to 3. All right, so I think we have to go. In our next class, we'll talk about the capital rationing. Please check that Play 2 PLC, right? If you have questions on that Play 2 PLC, maybe in our next class, before we start the class, you can ask your question. Please go back to it and check what is the law? Practically condition for granting capital allowance, the asset must be in use, meaning that you cannot charge capital allowance at year 0. Theoretically, they will tell you that if you have the capital allowance, right, sometime we'll get there. So if you have questions, I don't want to assume anything, just like if you have questions under that Play 2 PLC, right? So in our next class, we'll look at it together, right? Then our next class is on capital rationing, right? Capital rationing, from capital rationing to decision tree, from decision tree to simulation. Then we are done with costs. Then immediately we solve one question on decision tree, so you can solve that past question and you can solve that one. That's last direct question, you can solve it. So thank you so much, everyone. Do we have anyone that have questions before we go quickly? I have okay. Let's take question now. Any question?
Sir,
are we good?
My question is, sir, so the plant and the factory, we split it into the computation of our next
Yes.
present value, Abi?
Yes, sir.
Okay. Thank you, sir.
You're welcome, sir. All right. So thank you so much, everyone, for joining. And again, lastly, before we go, please, let's get professional associates. We are open for suggestions, ideas that can make us to improve in our words, in delivering our lectures. So if you have any areas of weakness that you think that we need to adjust, please do not hesitate to reach out to either Christy or I. You can send me DM with respect to that so that we can look at it together. Please, we are welcome any ideas that will make us to deliver. We are not competing with anybody. We are not competing with any center. We just want to deliver lecture for our our students. So please, if you have any area of weakness, you can reach out to us so that we can adjust. Remember, we are not competing with any center. We just want to be doing what we like doing, which is to deliver practical lecture, not theoretical, practical, right? So thank you so much, everyone, for joining, and enjoy the rest of your evening. Thank you.
Thank you, sir. Good night.
Thank you. Good night.